Sometimes history doesn't repeat, it rebrands. In the early spring of 2025, under the chandeliers of Mar-a-Lago, an accord was made. Not signed, not announced, but whispered into policy circles and traded across bond desks like a rumor too bold to ignore. They call it the Mar-a-Lago Accord, and it may be the most important economic realignment of the 21st century. Welcome to FluxFolio Finance, where global strategy, monetary power, and market tectonics meet. Let's go back. In 1985, the Plaza Accord realigned global currencies. America was running massive trade deficits, and the dollar was too strong. So the US made a deal with Japan, France, Germany, and the UK to weaken the dollar through coordinated intervention. It worked. Fast forward to 2025. The dollar is once again too strong. The trade deficit hit a record $140.5 billion in March 2025. Tariffs are back. Trump's second administration has imposed sweeping levies on everything from Chinese EVs to German machinery. The global financial system is fragmenting. The WTO is paralyzed, and the rules of post-war trade are being redrawn with every bilateral deal. Trump doesn't want another Plaza Accord. He wants his own. The Mar-a-Lago Accord isn't about consensus. It's about confrontation. In this vision, the US dollar must weaken, not through diplomacy, but through strategic disruption. Here's how. 1. Tariff shocks. Trump's new tariffs function as a currency tool. By raising import costs, they force exporters to lower their prices, effectively deflating foreign currencies relative to the dollar. It's a 21st century mercantilism hidden inside trade walls. 2. Capital flight incentives. Repatriation incentives allow US corporations to bring back overseas profits with minimal tax friction. That means more dollar demand at home and a drain on foreign capital systems. Add to that new deductions for foreign earnings reinvested in US infrastructure. Suddenly, America becomes the vacuum for global liquidity. 3. Foreign arm twisting. Leaked transcripts from behind-the-scenes negotiations reveal that South Korea, Vietnam, Taiwan, and even Switzerland are under intense pressure to let their currencies rise. Trump's team isn't asking, it's demanding. Welcome to Plaza 2.0, not negotiated but imposed. And here's the kicker. There's talk, unconfirmed, but repeated in policy memos, of tying the dollar to a commodity basket. Not gold, not oil. A synthetic index of US-produced energy, rare earth metals, industrial inputs, and digital asset metrics. A digital reserve peg. Sound wild? So did Bitcoin a decade ago. In Trump's playbook, this isn't about the dollar crashing. It's about redefining what the dollar is. Now enter the Fed. Jerome Powell, still chair in 2025, is walking a policy tightrope. Inflation remains sticky, especially in services. The yield curve has inverted again. Consumer credit is at record highs, and $7.6 trillion in US Treasuries must be refinanced in 2025 alone. But foreign appetite is thinning. Japan is repatriating assets to stabilize the yen. China is quietly selling. The EU is focused on its Green Deal and domestic capital formation. And so the Fed must decide, let yields spike and risk recession, or intervene quietly. Wall Street whispers of stealth QE are growing louder. Operation Twist 2.0. Standing repo backstops. Even yield curve control for long-dated maturities is back in conversation. This isn't coordination with the White House. It's a collision course, because just as the Fed attempts to uphold dollar credibility, Trump is pulling it down to supercharge exports and slash the real value of US debt. Meanwhile, the global monetary ecosystem is mutating. Brazil and India have doubled their yuan reserves. The UAE is testing oil contracts settled in a blend of dirhams and digital currencies. Singapore is pushing for regional FX pooling. Russia has fully de-dollarized and is promoting gold-backed tokens in Eurasian trade. And Tether, the stablecoin giant, is now holding over $150 billion in treasuries, effectively becoming a top 10 foreign holder of US debt. It's crypto propping up fiat, while fiat erodes itself to survive. The dollar isn't dead, but it's bleeding influence by 1,000 basis points. So why push it further? Because Trump understands something economists won't admit. A weaker dollar makes US exports competitive. It revives Rust Belt industries. It forces multinational firms to reinvest at home. It erases trillions in real debt burden. And in an election cycle, it sells. The Mar-a-Lago Accord isn't a treaty, it's a campaign. A coordinated disruption of the post-war order, dressed in populist packaging and executed through executive levers, to shift the dollar's value, to remake trade, to rebalance global power by economic means. But there are risks, seismic ones, if the dollar falls too far, too fast. There could be a foreign capital exodus from treasuries. Import costs would rise, reigniting inflation. Global reserve architecture could destabilize with no ready replacement, while emerging markets scramble to hedge in gold, Bitcoin, and bilateral swaps. And Trump's inner circle knows this. Stephen Moran, a senior Treasury advisor, has reportedly drafted a dual-currency contingency plan. A strong domestic dollar for internal consumption and a weakened trade dollar for international contracts. It echoes Britain's sterling strategy pre-Bretton Woods. So what should you watch? Dollar index, DXY. A sustained break below 90 confirms the shift Treasury auctions. Weak bid-to-cover ratios signal feared global FX reserves. Look for diversification into non-USD assets trade settlements. Any move away from USD in oil, chips, or rare earths is a canary in the coal mine Fed balance sheet. Hidden QE would mean monetary support for fiscal ambition. The Mar-a-Lago Accord may never be signed, but it's already being priced. It's a currency revolution in 3 acts. 1. Tariffs for pressure. 2. Liquidity for leverage. 3. Narrative for cover. It's Plaza reimagined. Bretton Woods reversed. And dollar diplomacy by other means. Thanks for watching FluxFolio Finance. Like, subscribe, and comment. Is Trump resetting the dollar or weaponizing it? Stay sharp, stay sovereign, stay strategic.